Okay, here we go. 3, 2, 1, live. Let me get situated here. Hey friends, how you doing? Ernie here, and this is the 0 Days to Expiration podcast. Today is Wednesday, January 12th. It's late in the day. We're about 45 minutes from the market close. Decided to do a podcast at this time only because it was kind of timely, and had to do a lot with relative performance of strategies, trading, opportunity, that sort of thing. And, a lot of people wonder, is it the strategy? Of course, a lot of it has to do with the strategy and whether or not you have an edge. But let's assume that you are an options trader. What is the best environment that you can be in to profit? What is going to give you the best opportunity? When are you going to have the best risk to reward situation? Now, in general, options trading is quite a bit different than, say, trading stocks, because you're trading a derivative, a complex instrument that has many different variables to it, unlike a stock, which behind the scenes obviously has a lot of variables that you have to consider. But when you actually buy the stock or sell the stock, it either goes up or it goes down based on whatever is happening in the market. An options contract, on the other hand, is a representation of that stock or any of these underlying assets. It could be a futures contract. It could be an index. And an options contract has, like any other contract, a period of efficacy, or a period that it is in play. So it has a start and a beginning, or a creation and an expiration. And there are two different types of options contracts. You can either do a put or a call. A put is where you're basically, that is a bearish trade. You are betting that the price is going to go down. A call is that you are betting that the price is going to go up. And you choose a strike price. From that price is the price from which you think it's going to go up or down. Now, that sounds an awful lot like a stock, but there is another part to this. For one, it's not a one-to-one relationship between the price of your option and the value of your option and the price of the stock. It fluctuates. That price fluctuates. The rate at which it is priced also fluctuates, and it's based on a lot of different things. But primarily it is based on the time you have left in the contract, the options contract, and the amount of volatility that is in the market. Now, this can get quite complex when you start thinking about it, but essentially, an options contract is a lot like an insurance contract. You pay premium on an insurance contract. And then if the contract or the contract comes to fruition, in other words, it meets the objectives of the contract, then you get a benefit. And, the options contract in a stock market is pretty much the same thing. Now, the important thing is, from a trader's point of view, is how can I optimize when I buy or sell one of these options contracts? Does it make a difference? With a stock, the only optimization is something that is apart from the stock. It's the underlying company and whatever it's doing. With an option, it's completely different. The optimization is all around not only the underlying price, that is one part of it, but it's also how much time is left in that contract and what is the volatility in that underlying asset. Those two aspects add an additional premium on top of the underlying price. That is what most traders are focused on. Now, in the market, there are essentially two different types of options traders. There are those that look at options strictly as a way to leverage stock. So they think that, well, okay, I can go long an option, just like I can go long a stock, or I can go short a stock by using a put. So I can do a call or a put for long or short, or bullish or bearish. And I can get into that option really cheap, and I can control a lot of stock with a relatively small amount of money. And then the return that I get will be amplified because there's leverage in the amount of money I get versus the potential gain I can get from the difference in price when the underlying stock moves and all of that. Now, when you're going long an option, there's something working against you, and that is the premium and the time left in that option. You want to make sure that when you go long that option, whether it's a call, a bullish direction, or a put in a bearish direction, that it either goes up or goes down faster than the expiration time comes to fruition. And that is because that over time, the premium that is determined by that time left in the contract and the volatility is constantly degrading, constantly decaying. And that's part of the value of your option. So your option contract is continually decreasing in value by that premium. Then, of course, it can be offset by the price of the underlying stock, whether it goes up or down, and that can add to it. But that premium, there are cases where you could go long on a call option. And let's say you're going long on that call option and you're betting that the price is going to go up. And then the price of the underlying stock does go up. However, during that period of time, the volatility, now you have to remember that the option is made up of the intrinsic value, which is the difference between the strike price and the price of the underlying stock that you have, plus the premium, the time premium and the volatility premium. So let's say that your underlying stock goes up, and so you figure, okay, my option price is probably going to go up. But let's say at the same time that volatility collapses and the time gets near the end of that contract. And so that portion of the options contract shrinks down to nothing. So much so that it offsets the gain that you would have made in the price difference. So you could have a long call option that the underlying goes in your direction, so you think you're a winner, but actually end up being a loser because the premium portion shrunk so much that it shrunk more than the underlying stock price would have added to the value of your option. I know that sounds crazy, right? Then why would you play it? Now, and it's the same way if you choose a put option and you want it to go down. However, a put option actually has a little bit of a skew on it because when price goes down on a long put, volatility tends to also increase. So put options tend to have a little bit more meat to them, or a little skew. And that's largely because the market tends to be biased to the upside. And so that volatility is something that you're counting on. Now, but in general, going long, whether it's a call or a put, is a tough way to trade options. Most people that trade long options, whether it's a long call or a long put, end up being losers because most of those option contracts expire worthless, the vast majority of them. So if they expire worthless and they're buying the option, there must be somebody on the other side of that trade that is selling the option. And if most of the people that are buying are losing, then conversely you would think that, well, most of the people that are selling are winning. And this is absolutely true. Most of the people that are selling the option are winning, or they're winning more often than the buyers of the option. All right, so now that we've got that established, that sellers of options tend to be the winners. And you can think of a seller of an option, someone who is collecting premium, kind of like an insurance salesman, because that's what they do. They are insuring prices by selling that option. And for that, they receive the premium that gets decayed in that options contract. That premium that is constantly going away from the buyer of an option is going towards the seller of the option. So now the seller of the option is in this very enviable position where time and volatility are on their side. And they, in fact, can win three ways, where the buyer can only win in one way. With the buyer, the only way they can win is if the price goes in their direction faster than the premium decays. The seller can win whether the price goes nowhere or the price goes against the buyer, or even if the price goes a little bit against the seller, so long as that amount that it goes against isn't bigger than the premium decay. So wouldn't you rather be the person who is the seller where they can win three ways as opposed to the buyer that can only win one way? Well, that's kind of a rhetorical question. Now, as I said, one of the principal aspects of pricing an option is volatility. It has a direct impact on the value of that option. The more volatility, the more pricey an option. And you've, I'm sure, heard of the old adage, and this applies to just about anything: buy low, sell high. And it's the same thing with options. You want to buy things that are low, and then sell them when they're high. Or the reverse, you want to say, I want to sell them when they're high and then buy them back when they're low. And that's the case with an option seller. With the zero DTE trade, that's what we do. We sell options, and we sell them at the time, at the zero or last day or last hours or last minute of expiration, where the option decay is at its maximum. And that's totally on purpose, because we recognize that there's a much greater opportunity for us being sellers, first of all, and also taking advantage of that premium decay. So our goal is to find, an area or a place where we can place one of these premium collection strategies, whatever that happens to be. In our case, we tend to use butterflies or even ironflies or anything that will give us a wide range of prices where we can collect premium. And hopefully we do it in a time frame where price will be within our range and we can be there and be the benefactors of that. So the more volatility there is in the market when we place our trades, the better. And then if volatility were to lower while we're in that trade, that's even better. So generally, we like situations where volatility is relatively high. because that gives us the chance to sell really expensive options. When we sell things that are expensive, we can then buy them back when they're cheap. And if they get cheaper faster than any other time before, any other time of the life of that contract, which happens to be that very last day of expiration, well, that puts another edge in our pockets. And so that's what we do. So that's why high volatility, or relatively high volatility, benefits the zero DTE trader, and quite frankly benefits anybody who is selling options or option premium. So hopefully that makes sense. So that's what I wanted to say. There are other things too. When you have a high level of volatility, that also implies that you have a greater expected movement of price. When you have a greater expected movement of price, that generally means that price tends to move, make these long, extracted moves with very little noise in that move. So one might say that there's a great signal-to-noise ratio when you have a volatile market and large expected moves. Now, over time, volatility may look like a lot of noise, a lot of up and down and choppiness. But when you're in the thick of it, in that very last day, in a very small time slice, a volatile market produces nice, smooth, extracted moves. And that's all we care about. When price, or when the market has very low volatility, you tend to get this sort of grind, up, down, a lot of noise, no specific direction. Even if that direction is slowly meandering towards a higher move or a lower move, the volatility in that move may be very small. Each individual move may be very tiny. And so now the noise is actually larger than the signal or the direction, especially when you're talking about that very finite time frame that you're dealing with, that last day of expiration or that last waning hours. Those things are working against you. So all of these reasons are why high volatility is the benefactor, is the benefit of trading zero DTE. So we do much better when volatility is elevated. Now, fortunately, volatility, for the most part, stays slightly elevated. Or there's always some kind of event. Something is going to happen. Something that will push it up and put it into that zone where we can sell the option and then collect it as volatility then calms down, and then during that time, that's when premium is flowing to the option seller at its maximum rate. It's like shoveling snow downhill instead of uphill. So that is why, now in our case, volatility, there's a range that we like to be in where we sort of optimize this whole idea. And we look at certain indicators or indexes that help us determine, where that range is. And we don't actually use the range for doing any kind of calculation. It just tells us that, man, when volatility is here, we tend to have a better time, and we can be a little more creative, a little bit more risky. We don't have to be as risk adverse when volatility is within that range. And also our trades, when we put on an option strategy, it makes it much easier when volatility is elevated, because those strategies get pumped up with premium and they give us better risk to reward scenarios. when volatility is very low, it's very difficult to put on a trade that will give you the kind of risk to reward that you want. So you have to be much more selective and maybe more conservative. So it seems like almost the opposite. With low volatility, you have to take less chance. With high volatility, you can take greater chances. And in fact, our probability of profit, or our win rate, tends to go way up when we have higher volatility. When things are more volatile, when things are crazier, you make more money. It's almost counterintuitive, but that's how it works. We look at the VIX as our gauge of where volatility is. And right now, the VIX is right at the bottom of what we consider our Goldilocks zone. Our Goldilocks zone is a VIX that is anything above 17 and below 34. Above 34, things start getting a little too crazy. Below 17, they are so mundane, so anemic, that you just want to slash your throat. No, I'm just kidding. You don't want to do that. So the real sweet part is when we're, say, between 20 and 30. And that's when trading the 0 DTE becomes a real pleasure. And if you can maintain that level for a while, that's great. If you're skating along the bottom of the VIX or at the bottom of that Goldilocks zone for a long period of time and you get an occasional spike up and then right back down, that's like one of the worst environments because the opportunities are so fleeting. And that's the kind of environment we've had a few times. Like the end of this year, the vacation week after Christmas and between New Year's, and this first week of the new year were like that. And so it's been difficult to make a good profit. And another time like that was in October. The middle to end of October was also like that. Most of the other time, we had lots of volatility and it was smooth sailing. So during those times when we have that low volatility, we adjust our strategy. Well, the strategy has a tendency to be self-regulating, so it doesn't allow us to put on, wild and extravagant trades. It forces us to put on smaller, more reserved trades. But when you have that situation where volatility is going along the bottom, skating the bottom very low, and then you get this minor little spike up and you think, okay, maybe I can sink my teeth into that. That's kind of I don't know, maybe you call that like a false profit. Well, there was a pun intended there. Get it? False profit. And those environments are very difficult. Now, if you had a nice strong move in volatility, something really horrible happened in the market and it pumped way up, then at least you can get volatility sustained for a little bit, and then now your trading environment becomes quite pleasurable. So all of these reasons, this is why high volatility benefits the 0 DTE trader. Hopefully that makes sense, and I hope you enjoyed this podcast. We'll see you on Friday. Take care, and peace to you all.